All right, let's get right into it. What we're about to go through here, this is not your typical trading guide. Think of this as a battle manual, straight from a trader with 25 years in the pits, all about how to navigate the markets with a small 20,000 rupee account. Look, this isn't about getting rich quick. It's about survival. It's about precision hunting in a very, very dangerous environment.
And that quote, man, it just says it all. You have to forget everything you think you know about patient investing. When you're working with this little capital, every single move is critical. You're not casting a wide net here. You're a sniper with one bullet. So your mindset has to shift from passive trading to active, aggressive hunting.
So yeah, you can consider this your peek inside the inner circle. This is that raw, unfiltered advice that the pros share among themselves. It's designed specifically for scalping the big indices like the NIFTY and Sensex, where speed and discipline are absolutely everything.
Okay, first things first. We need to understand the field of play. And the 20,000 rupee battleground, it's unlike anything else. It is fast, it's brutal, and it leaves you with absolutely zero room for error. This number? This is your first hard reality check. With a small account, just one single trade that you take based on hope instead of actual evidence can wipe out 20% of your entire capital. Poof, gone, in minutes. The stakes are just incredibly high right from the get-go.
So, to survive on this battleground, you're going to need the right weapons. And look, we're not talking about a bunch of complex, confusing indicators. This is about a lean, mean, effective arsenal that gives you the intel you need right now.
Your number one weapon is the 9 EMA. Just think of it as your signal. We use the 9-period one because it is built for speed. It hugs the price super closely on a 1-minute chart. And that immediate feedback, it tells you exactly when to pull the trigger and, just as important, when to get the heck out.
Now, if the 9 EMA is your signal, then the VWAP? Well, the VWAP is the boss. It basically represents the average price where the big institutions are playing. It dictates the entire mood for the day, and your job is simple. You do not fight the boss.
Which brings us to the golden rule. And I'm telling you, this is completely non-negotiable. If the price is trading above the boss, you are only looking for buys. You're trading calls. If it's below the boss, you're only looking for sells. You're trading puts. Trying to fight that institutional flow is the fastest way I know to bleed your account dry. Period.
The ammunition you choose to use is just as critical. For a small account, you have to stick to at-the-money options. We call them ATM. They give you that perfect sweet spot for a scalper. They move nicely with the index, but without that crippling time decay that you see in other kinds of options.
And this right here shows you the danger perfectly. So many new traders, they get lured in by those cheap out-of-the-money options, the OTMs. But for a small account, it's a death trap. That time decay, what we call theta, it acts like a poison. It will eat your premium alive, even if you guess the direction right. So you've got to stick to ATM.
All right, we've got our tools. We know our rules of engagement. Now, let's talk about execution. These aren't just theories, okay? These are specific, high-probability plays you can actually look for every single day. The first one is the 9:20 a.m. scalp. It's a classic open-range breakout, but with a professional twist. So first, you mark the high and the low of that very first 5-minute candle. Now, second, and this is the part everyone gets wrong, you do not jump in the second it breaks. You wait for the price to break, come back to retest that level, and only then do you enter when you see confirmation. That retest, that's your defense against all the fake-outs. Now, here's a more advanced tactic, learning to spot the divergence trap. So, have a look. In that first row, you see the Nifty index is making a new high. Looks bullish, right? But, and here's the trap, look at the second row. The call option premium is failing to make a new high. That mismatch, that divergence, that is a massive red flag. It's telling you there's hidden selling going on, and a reversal is probably coming. This is a setup you absolutely have to avoid. To a pro, the option chain isn't just a bunch of numbers. It's a battlefield map. It shows you exactly where the big money is digging in. You can spot fortresses. These are the strike prices with huge open interest, basically where all the bets are stacked up. That's where big players will defend. And you can spot the squeeze, which is when those same players get panicked, and their frantic selling or buying creates this explosive momentum that you can ride.
A really quick way to get the mood of the market is the put-call ratio, or PCR. But the real secret here, it isn't the static number itself. The secret is the direction it's moving. If you see the PCR suddenly shift from, say, 0.8 to 0.9 in just 10 minutes, that's your signal.
It's telling you the bulls are starting to take control, even before it's obvious on the price chart.
And now we've come to the most important section of all. Seriously, you can have the best strategy in the world, but without these cold-blooded risk management rules, a 20,000 rupee account, it just won't survive. This is everything.
This number is your eject button. Your stop loss on a Nifty scalp is 5 to 7 points. It's not 8, it's not 10. If the trade moves that much against you, you are out. No questions asked, no averaging down, no hoping it'll turn around. The decision is already made for you. You execute, you get out, and you live to fight another day.
For every single trade you take, you must be aiming for a minimum risk-to-reward ratio of 1 to 2. What does that mean? It means if you are risking 5 points with your stop loss, your target has to be for at least a 10-point gain. This is the simple math that keeps you profitable in the long run, even if you only win half of your trades.
3. That's it. That is the absolute maximum number of trades you are allowed to take in one day. Why? Because with a small account, your biggest hidden enemy is often the brokerage fees and the taxes. Overtrading, even with a bunch of small wins, will grind your account down to 0. It's all about quality, not quantity.
And finally, before you ever click that button, you run this mental checklist. Is the price near a big round number, like 22,500, where you can expect a fight? Is the India VIX, the market's fear gauge, creeping up, making things more volatile? And most importantly,
You have to ask yourself this one final question. Be honest. Is this trade based on clear, observable evidence from your system, or is it based on a gut feeling, maybe a tip you heard, or just plain old hope? Professional hunters only act on evidence, and with a 20,000 rupee account, you simply can't afford to be anything less.